Welcome to vTalkInsight, Allocator's Lens Daily for April 17th, 2026. Across assets, the striking contrast today is between record equity levels and increasingly strained physical energy markets, with interest rate volatility easing and the dollar's safe haven role looking less reliable. Allocators are weighing powerful AI and export-driven growth stories against mounting stagflation risk from oil and metals. With that backdrop, let's start in equities, where a relief rally has morphed into a tech-led surge that now has to justify stretched valuations. In equities, the dominant feature is a renewed risk-on phase, with global indices back at, or above, their pre-conflict levels and United States benchmarks hitting fresh record closes. Gains that began as short covering have broadened into momentum buying, helped by falling interest rate volatility and a slide in equity volatility back below the high teens, which together create a powerful backdrop for beta exposure. Flows confirm the mood, with the United States equity market reportedly seeing one of its strongest recent 8-day inflow runs as investors move cash like holdings back into risk assets. Leadership remains firmly anchored in technology, especially AI-linked hardware. Semiconductor indices have surged since the late March trough, significantly outpacing software peers, underscoring investor preference for tangible AI infrastructure. Taiwan's semiconductor has become a poster child for this theme, reporting roughly 58% year-on-year profit growth, repeatedly lifting guidance, and now generating more than 60% of its sales from AI chips, while still expecting over 30% revenue growth this year. Positive read across to names like NVIDIA, ASML, and other chipmakers has helped push global tech benchmarks higher, while strong earnings from large banks and select consumer names support the idea of resilient aggregate profits. There are signs of healthier breadth, with gains extending beyond mega-cap technology into indices, such as the Russell and even parts of the software complex, as some investors argue the recent rallies reflect more than just technical bounces. However, concentration risk remains pronounced. The largest technology names, often dubbed the mega-cap cohort, continue to account for the vast majority of recent advances in the S&P, and technology and AI-related stocks now make up nearly half of that index's market value. This mix of better breadth on the margins and still dominant leadership at the top keeps debates alive about whether today's enthusiasm resembles past speculative episodes. Against that optimism sit several constraints that matter for multi-asset portfolios. Valuations are elevated, with euro area equities around 17 times earnings and the S&P closer to 25 times, while equity risk premiums have risen as investors now demand almost a full percentage point more expected return per dollar of future earnings than before the war. At the same time, many companies face margin pressure as weaker demand and the inability to fully pass on cost increases collide with a different inflation regime than in 2022, leaving promotional cuts as one of the few remaining levers. Higher energy and input costs are already biting more cyclical and travel-exposed sectors, and forward visibility is deteriorating in areas such as airlines, where booking curves are shortening and large order books look more vulnerable. There is also a growing disconnect between equities, which largely price in strong earnings and manageable oil and commodity specialists, who warn about tight physical markets and potential shortages, especially in Asia. If elevated energy prices persist beyond a few months, analysts expect a two-stage hit to earnings, starting with energy-intensive firms and then spreading through demand destruction that could tilt performance toward more defensive sectors. For allocators, the equity story now hinges on whether AI-driven earnings upgrades and strong trading revenues at banks can continue to outrun these cost and growth headwinds. Watch breadth, margin commentary this earnings season, and any sign that consumer strain and energy shocks are finally feeding into downward revisions. Turning to rates, government bond markets currently look calm on the surface. United States Treasury yields are little changed across maturities, with the 2-year around 3.75% and the 10-year also steady, even as equities set new highs. Interest rate volatility, which more than doubled in March, has since declined, helping to underpin the cross-asset relief rally and easing pressure on sectors and regions that underperformed during the earlier spike. Market participants see a very low probability of Federal Reserve rate cut in June, as headline inflation hovers close to 4% and policymakers prefer to wait and watch inflation expectations. Globally, central banks are signaling caution rather than an imminent pivot. In the euro area, an April rate cut is seen as off the table, and policymakers are likely to keep rates unchanged this month while leaving June as a live option. The Bank of England has pushed back against earlier aggressive hike expectations, and current pricing implies just over one additional move by year-end as officials lean on forward-looking wage and price surveys rather than lagging data. Commentary suggests that European and United Kingdom rate hike expectations may now look excessive, with attention drifting to the 2 to 5 year part of the curve, which offers relatively high yields without the term premium risks associated with very long maturities. Beneath the calm, there are structural fragilities that matter for duration exposure. Governments are issuing more short-term debt to save on interest costs, pulling forward refinancing risk as large volumes will need to be rolled over sooner in what could be volatile markets. At the same time, central banks have reduced their sovereign bond purchases as part of balance sheet reduction, leaving more of the absorption burden to price-sensitive investors, such as asset managers and hedge funds, a shift that can amplify swings in yields and liquidity conditions. Some analysts warn that if inflation stays sticky while United States earnings keep accelerating, the Federal Reserve may need to contemplate a somewhat higher terminal range around 4 to 4.5%, a scenario that could revive the period when bonds and equities sell off together and would ripple quickly into credit and foreign exchange. In credit, conditions still look benign at headline level. High-yield spreads have normalized after widening around the Iran conflict, and there is little expectation of a conflict-related wave of downgrades or defaults. Recent stress episodes appear largely idiosyncratic rather than systemic, and major banks emphasize that the broader economy and consumer health remain solid, echoing the tone from strong bank earnings and trading revenues. Even in the Gulf, where war disruption was most acute, states have returned to capital markets, raising close to $10 billion in private bond sales this month, underlining that global investors are still willing to fund fundamentally sound borrowers. The tightness of credit spreads, however, is not purely about corporate strength. Analysts note that declining corporate yields alongside rising sovereign yields are being driven in part by deeper market liquidity and the growth of electronic trading, rather than by a broad improvement in fundamentals. With government debt and issuance climbing, corporate bonds can appear relatively attractive on a spread basis, especially as corporate leverage has generally fallen while perceptions of sovereign risk have edged higher. Looking ahead, major technology and AI hyperscaler firms are expected to finance a significant portion of their roughly $4.1 trillion of planned capital spending over the next 5 years through bond issuance, blurring the line between equity and credit markets and potentially increasing cross-asset correlations. Private credit remains an important and growing part of the picture. Spread widening and some redemption-related selling have created more attractive entry points for institutional capital. Yet recent outflows represent only a small slice of a market approaching $800 billion, and retail and wealth channels continue to add exposure. Investor interest is also broadening beyond corporate direct lending into areas such as real estate and infrastructure debt, where similar return targets can be paired with explicit asset backing, even as regulators scrutinize bank lending to private credit funds for potential contagion channels. Across both public and private credit, there's a consistent message that issuer selection will be the main driver of returns, particularly around companies tied to AI and those facing margin pressure or reduced visibility in sectors such as airlines and cyclicals if a stagflation scenario gains traction. Foreign exchange markets are sending a more nuanced signal than in past energy shocks. The United States dollar's safe haven appeal has weakened, with recent episodes of higher oil prices not automatically triggering broad dollar strength, reflecting reduced perceived tail risk and a shift in how investors hedge shocks. At the same time, the relative appeal of United States equities has eased as pure tech outperformance shows signs of fatigue, and expectations build that the Federal Reserve could ultimately be more dovish than some European peers, a mix that can cap the upside for the dollar. That said, the path is not one way. If inflation forces the Fed toward a higher terminal rate, the dollar could quickly regain its defensive bid, making policy and inflation data key drivers for currency allocation. China stands out on the other side of the ledger. First quarter growth reached around 5%, beating expectations on the back of strong exports and manufacturing, with only muted evidence so far that the regional conflict is denting activity. Robust trade flows and resilient export demand are seen as supportive for the Chinese yuan, with some expecting the dollar versus yuan rate to drift lower towards 6.40 as global appetite for manufactured goods holds up. For allocators, this leaves foreign exchange as both a barometer of shifting growth and policy differentials and a potential buffer or amplifier, depending on how the energy shock and ceasefire negotiations evolve. Commodities, and energy in particular, remain the macro fulcrum. Global crude prices have climbed more than 30% since the onset of the war, and some physical grades are reportedly changing hands at up to $150 per barrel as supply disruptions bite. Estimates suggest a loss of more than 10 million barrels per day of supply, with Europe facing the prospect of only about 6 weeks of jet fuel inventory, raising the risk of flight cancellations if shipping through the Strait of Hormuz remains constrained. Strategic petroleum reserves have already been drawn down by roughly 500 million barrels, implying future upward pressure on prices as inventories are rebuilt, especially with waivers on Russian and Iranian crude exports set to expire. Despite the severity of the physical squeeze, the expected macro impact is more measured, at least in the base case. Analysts see the drag on United States growth as less than half a percentage point, with consumers generally resilient unless gasoline prices move decisively above $5 per gallon. The bigger issue lies in inflation and corporate earnings. Persistently high commodity prices, combined with still solid consumer demand, raise near-term inflation risks, and earnings are likely to feel the strain in two phases. First through direct hits to energy-exposed companies, then via broader demand destruction that could favor defensives over cyclicals if high prices persist beyond 6 months. Already, sectors like airlines are reporting shorter booking horizons and more cautious customers, while order backlogs in parts of the industrial complex look increasingly vulnerable to any escalation in supply disruptions. Beyond oil, industrial metals are also flashing tightness. Aluminum prices have jumped more than 15% quarter-on-quarter after Middle East disruptions removed around 2.5 million tons from the global market, adding to cost pressures for manufacturers. Short-term energy policy is responding on two fronts at once, with governments encouraging both increased fossil fuel exploration and an accelerated build out of renewables, particularly in Asia and the United Kingdom. Higher interest rates raise financing costs for clean energy, but the elevated price of fossil fuels keeps many renewable projects economically competitive. All of this reinforces the tension between commodities and equities. While equity markets largely discount a smooth path of growth and contained oil, commodity specialists emphasize tight physical balances and ongoing risks to energy security. For cross-asset portfolios, the key watch points are ceasefire negotiations, inventory levels, and how quickly any demand destruction shows up in inflation data and earnings guidance. Stepping back, the cross-asset picture is one of powerful optimism in equities and still tight credit spreads, layered on top of a rates market that looks calm, but is quietly grappling with higher-for-longer policy, heavy sovereign issuance, and renewed inflation risks. The dollar's safe haven role has softened just as China's export engine and the yuan gain support, while commodities led by oil and aluminum remain the main potential spoiler by keeping the risk of a stagflation shock alive. For allocators, the coming weeks will hinge on three fronts: how corporate earnings and margins absorb higher input costs, whether energy disruptions ease or persist into the second half, and how central banks interpret the mix of sticky inflation and resilient growth across their June meetings. Keeping an eye on market breadth, credit selection, currency moves against the dollar and yuan, and the evolving physical energy backdrop will be crucial to understanding whether today's risk on tone can endure. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.